In a word, the year in real estate saw wealth destruction, given the rapid rise of interest rates. But 2023 should bring falling rates and that destruction replaced by disruption. Let's talk real estate with Hines Global Chief Investment Officer David Steinbach. He's with us now. Good to see you, sir. So you say disruption brings real estate opportunities. Play that out for us. And where exist those primary opportunities?
Great. Well, look, thanks for having me. So Hines is a $100 billion global investment manager. We focus on real estate. We're in about 30 countries around the world. I'm actually calling from you here in Davos today. So I would say that disruption is definitely a topic here as well. I think that investors right now are really seeing the change that's already happened, right? Interest rates, kind of riding this wave of low interest rates, and the cap rate compression that comes with that is over, and now the hard work of asset management really begins, and that's really what's in front of most investors today. I think, though, the general mood that I'm feeling here in Davos, though, is that I think that people are pretty somber about the realities of the market. And really starting to focus much more on the beginning of a new cycle rather than the end of an old one.
Sure. And rates that, should we believe, begin to fall, are they optimistic about investment opportunities in real estate as we move forward?
Yeah, so I think that the way to think about the built environment is certainly one is that for an institutional investor, real estate is a longer term investment that we're making. So it's not something that we're flipping in and out of like equities or bond. And most business plans are lasting 5 to 10 years. And so in light of that, I mean, interest rates are certainly a driver of value, and they've had their impact this last year. I think that obviously if rates continue to move in this coming year, that'll also be a driver. But I think what I'm saying, though, the focus is really on how to create the value at the real estate itself, how to drive rents, how to create something that is special and unique, something that is going to outperform within the context of a particular market. But where the rates are today, again, it does affect value. But I think most real estate investors are thinking longer term when they're underwriting a deal today.
Give me a sector and a region in terms of housing that you are optimistic about as we move forward.
Sure. Yeah. So Hines is involved in really all the major product types. We're in multifamily, we're in office, we're in logistics, retail. And certainly in the housing sector, I think particularly in apartments, which is what we focus on with our institutional and retail clients, it's really what is interesting about that asset class is the fact that rents mark to market every year. And that is different than the other major product types where investors are relying on a bit longer term leases. And the fact that mark to market every year means two things. One is you are going to see, as fundamentals have come down in many markets, particularly here in the United States, you will see returns come down as well. With that said, on the other side of recovery, it'll be the first to come back up because, again, you're marking to market at a much faster pace than the other product types. So look, broadly, I do think that demand around multifamily, while it has slowed, I do think that given this dynamic in the lease term, that it will be one of the first things that investors will be focused on the other side. And look, fundamentals in the United States, they are declining. So you have to focus on the fundamental real estate you're buying. And again, think longer term. I mean, you're buying something today, you're going to own it for 5 to 10 years. You want to make sure what you are going to buy today is something that will perform in that time frame.
Let's turn to office now, and one of the big question marks that lies ahead. Are you bullish or bearish, and what's been the impact of remote work, and do we know the true impact just yet?
Sure. So the way we are obviously investing is around the world, and I think this return from work question is a really interesting one, because when you zoom out and look at the world in total and look at how everyone has responded post-COVID, every country is not in the same place in terms of how much remote work that they're relying on. So Asia, for example, would be one end of the spectrum, and frankly, the West Coast of the United States would be the other end. And basically all the geographies are somewhere in between there, with Europe being somewhere in between as well. And so what that tells me is two things. One is it says that whatever you might be experiencing today in your market that you're seeing every day is not necessarily the felt experience of those around the world. So as an investor, you have to think You have to think globally in that perspective. But the second thing is that what we're seeing is that there is a steady trend back. The chart is up and to the right. And even markets that's like in Asia, where it was nowhere near like what it was in the West Coast of the United States, for example, even that is on the right road, if you will. With that said, what we're seeing as well is that particularly here in the United States, it statistically seems to us that 90% of the tenants are chasing about 10% of the space. And so if you own projects today in that 10%, what we're seeing in our portfolio is they're actually performing really well. I mean, we're seeing rents within that narrow band, which is the highest quality, obviously, some of the highest rents that we've done. We've got projects in New York, and it is surprising when you see the headlines and see the data. But what's interesting, though, is despite that dynamic, the 90 chasing the 10, capital markets seem to be painting a much broader brush across the product type and really not seeing through that yet. I think that'll be another thing that we're going to see evolve in the next coming quarters, where investors are going to be looking a bit more carefully at what exactly is happening in fundamentals and look at the data as they do their due diligence. I think that they'll take a turning view.
All right, check back with us in a few months. David Steinbach, Hines Global, joining us from Davos. Appreciate it, sir.